Are we going into a recession? I don't know, but let's find out. Hi, I'm Mark with Best of Us Investors. I've been investing for 40 years and would like to share some of my insight with you today. I'm not here to tell you what to invest in, but to provide you with some information that may help you become a better investor. Please hit the like button and also subscribe to the channel if you appreciate this content. Remember, this is for educational purposes only and is not financial advice. Okay, let's get started. Every month, an important economic indicator is released that for the past 10 years was kind of a Yana report, but not anymore. I'm talking about the CPI, or Consumer Price Indicator. This is basically an indicator of inflation as felt by us, the consumers. Now, we really don't need a government report to tell us that almost all prices of things we consume have gone up recently because, well, we experience it every day. However, the CPI provides us with trends concerning inflation that can help us be better investors. In addition, we're going to explore if the CPI is a leading indicator for predicting a recession. So let's get into it. So today we're going to look at the Consumer Price Index, or the CPI. And the CPI is used basically by industry and people to measure and put a gauge on the inflation and a sense of what consumers like you and I are paying. So if you look at the Consumer Price Index, it's a measure that examines the weighted averages of prices of a basket of consumer goods, such as transportation, food, and medical care. It's calculated by taking price changes for each item in the predetermined basket of goods and averaging them. So they take the basket of goods, determine what the price is, and average them by the number of goods in the basket. Changes in the CPI are used to assess price changes associated with the cost of living. Now, it used to be the cost of goods, and we'll talk about that a little later in the video. The CPI is one of the most frequently used measures of inflation and deflation that may be compared with the Producer Price Index, the PPI, which instead of considering prices paid by consumers, looks at what businesses pay for inputs. And what that basically is what a business would pay for the materials and labor and such, and that obviously gets passed on to you. So let's look at a little bit of what the CPI is and who puts it out and how we base it. The U.S. Bureau of Labor Statistics, the BLS, reports the CPI on a monthly basis and is calculated as far back as 1913. It's based upon the indexed average for the period between 1982 and 1984 inclusive, so those are their base years. So they set that at 100. So a CPI reading of 100 means that the inflation is back to the level it was in 1984. If you have a reading of 175, that would indicate a rise in the inflation level of 75%, okay, or 225, rise of inflation of 125% from that time frame back in 1982 and 1984. The quoted inflation rate is actually the change in the index from the prior period, whether it's monthly, quarterly, or yearly. Though it does measure valuation in the price for retail goods and other items paid by consumers, the Consumer Price Index does not include things like savings and investments that can often exclude spending by foreign visitors who may come to our country. So how is CPI used? The CPI is an economic indicator, as we've talked about. It's the most widely used measure of inflation and, by proxy, of the effectiveness of the Federal Reserve's monetary policy. A CPI gives the government, businesses, and citizens such as us an idea about price changes in the economy and can act as a guide in order to make informed decisions about the economy. Of course, by the time they report it, we've already known that our gas prices have gone up or our food prices, but that's what it is. The CPI and the components that make it up can also be used as a deflator for other economic indicators, including retail sales and hourly weekly earnings. Additionally, it can be used to value a consumer's dollar to find its purchasing power. Generally, the dollar's purchasing power declines when the aggregate price level increases and vice versa. Well, that just means that when prices go up, your money doesn't go as far. So let's take a look at what inflation is, because the CPI is a measure of inflation. So we'll just get a definition, go into the Webster Dictionary, down to the economics side, and we can see inflation is a continuing rise in the general price level, usually attributed to an increase in the volume of money and credit relative to the availability of goods and services. So what that's saying is we have too much money chasing too few products and services. And during the pandemic, you can see that we had a lot of stimulus money that was separated out and sent to the masses. And then along with supply chain issues on the supply side, creates what we're seeing today in inflation. So let's go over for a quick definition of what the money supply is. And the money supply is all the currency and other liquid instruments in a country's economy on a date measured. So the money supply roughly includes both cash and deposits that can be used almost as easily as cash. So economists analyze the money supply and develop policies revolving around it through controlling interest rates and increasing or decreasing the amount of money flowing into the economy. Public and private sector analysis is performed because of the money supply's possible impacts on price levels, inflation, and the business cycle. In the United States, the Federal Reserve policy is the most important deciding factor in the money supply. The money supply is also known as money stock. So we measure how much money is in the system based on two measures, the M1 money supply and the M2 money supply. So the relationship between the M1 and M2 money, M1 and M2 money have several definitions ranging from narrow to broad. The M1 money supply equals coins and currency in circulation plus checkable demand deposits plus traveler's checks. The M2 equals everything in the M1 supply plus savings deposits, money market funds, certificates of deposits, and other time deposits. So here's a chart of the M2 money supply. And as you can see, it goes back to 1960. And in 1960, we had 290 million in money supply circulating. And over the course of time in the gray areas or recessions, you can see how the money supply has increased. And then came right here before the pandemic, and you can see we're about $15.4 billion in money supply. And then with all of the stimulus checks and buybacks and everything that the Fed is doing, balance sheet, you can see that the money supply right now is about $218 billion. So here's a chart of the M2 money supply going back to 1960. And as you can see, we were a slow and steady increase in the money supply. We got into the 90s and the 2000s, 2008, going up through the crisis, continually steady going up through 2010 through 2020. And you can see right here we're about 15.4 trillion right before the pandemic. And then the pandemic hit and we injected a lot of money into the system through the Fed. And now we're at $21.8 trillion into the money supply. So this feeds into the inflation theory of the money supply causing higher inflation. So today's inflation rate, as just released back on March 10th, the latest one we have for February, shows that inflation soared to 7.9% in the past year, a fresh 40-year high. So that goes back into the 80s for inflation. And the causes were propelled by surging cost for gas, food and housing. Consumer inflation jumped to 7.9% over the past year, the sharpest spike since 1982, and likely only a harbinger of even higher prices to come. The increase reported Thursday by the Labor Department reflected the 12 months ending in February and did not include the oil and gas price surges that followed Russia's invasion of Ukraine. Now, you hear a lot on the news that it did include that, and that was the cause of our spike of inflation, but this report shows differently. Since then, the average gas prices nationally have jumped about 62 cents a gallon to $4.32, according to AAA. Even before the war, further accelerated price increases, robust consumer spending, solid pay raises, and a persistent supply shortage had sent U.S. inflation to its highest level in 4 decades. What's more, housing costs, which make up about a third of the government's consumer price index, have risen sharply, a trend that's unlikely to reverse anytime soon. So let's go look at what's actually in the CPI and how high each commodity has, or consumable that you look at, has gone up over the last year. So to do that, we're going to the U.S. Bureau of Labor Statistics website. And we can go down a little bit here, and So here's your chart of the 12-month percentage change consumer price index. Okay, so you can see all items are up 7.9%. So there's your inflation rate. If we break it out into food, 7.9%, energy 25.6%, and all items less food and energy is 6.4%. So they take our two big players out here. When we look at all items, we can click on it. Or let's go to food. When you go to food, food at home was up 8.6%. So that's the amount of money you're paying to eat at home. And then food away from home is 6.8%. So if you go out to eat, that's what you're going to find. When you do go out to eat, full service meals and snacks are up 7.5%, and limited service, like a fast food restaurant, would be 8%. If we go into energy, we can dig into this. Your energy commodities went up almost 40%, and let's see what that is. So that's fuel oil up 43.6%, and energy commodities 38%, gasolines basically. And what we have left really outside of food and energy, we look at apparel's up 6.6%, commodities less food and energy, new vehicles 12.4%, used cars and trucks 41.2%, alcoholic beverages 3.5%, tobacco is up 7%. We looked at services, shelter, okay, the cost of rent, the cost of being at home 4.8%, medical care 2.4%, transportation services 6.6%. So you can see that prices all over have gone up, and 7.9 is what we're looking at today. And again, the latest numbers were up 0.8% from last month and 7.9% for the year. So let's just take a look at a chart and correlation between high inflation and recessions on this chart. You can see that the gray areas here are recessions. So as we go across from 1960, as inflation is going up and up and up, and then once you see we hit a recession in 1970s recession, high inflation, consumer price index falls. Then we came to a point, we went up in the 70s, in the mid 70s again, and had a recession, and again the CPI falls. And then coming into the 80s, you can see inflation rising again, and the CPI falls, and then it goes back up in the early 80s, and again recession, and the CPI falls. And then we've gone through a period through the 90s, and we started rising, recession, CPI falls. Get into the 2000s, we have rising inflation, recession, CPI falls. Come into the 2008 financial crisis, you can see CPI is up, recession, CPI falls. All the way into the pandemic, you can see here a small recession, and now here we are today. So you can take what you want out of this chart, but it appears that there's a correlation with the high rate of the CPI and inflation with a pending recession. So keep that in the back of your mind when you're investing. There's several other charts and indices we can go over as we go forward. This is just one that's been in the news, so I just wanted to explain it a little further for you guys. One more thing we should discuss about the CPI is there is a little bit of a controversy on how it's calculated. And here in Investopedia, it talks about originally the CPI was determined by comparing the price of a fixed basket of goods and services spanning two different periods. In this case, the CPI was a cost of goods index, COGI. However, over time, the U.S. Congress embraced the view that the CPI should reflect changes in the cost to maintain a constant standard of living. So consequently, the CPI is involved into a cost of living index, or a COLI. So over the years, the methodology used to calculate the CPI has undergone numerous revisions. According to BLS, the changes remove biases that cause the CPI to overstate the inflation rate. So if you look at, some people will come out with charts that say, well, if you look at how they calculated in the 1970s to how they calculate today, the real CPI or inflation rate would be 15% to 20%. So I just want you to be aware that there's controversy, and when you change the way you measure something, you also change the outcome. But each of us personally know that inflation is rising because we deal with it every day when we go to the grocery store, we pay our electric bills, and especially when we fill our cars up with fuel. So Always do your own due diligence when looking into different indices that you see, and just don't take it all for granted that what you're seeing is correct or not manipulated. Inflation is something that a lot of current investors have never experienced before, but it is something we should take serious, as inflation acts as a hidden tax. It reduces our discretionary spending and affects the long-term growth of our economy. Inflation is currently reported as 7.9% in the CPI report. Increases in wage growth has been reported at 5.1%. This means your wages are not even keeping up with the cost of goods and services. We as consumers will either need to increase our income or reduce our spending. Consumer spending represents about 80% of the economy. To me, this means our economy will be slowing, not growing. Are we going into a recession? Who knows? I have my own opinion, but everyone should do your own homework and then decide for yourself. Then adjust your investments accordingly and make your own decision. You are responsible for your future. Prior to investing in any security, make sure it fits within your time horizon and risk tolerance. Also, don't invest in something based on hope. Hope is not a strategy. Know what you own and why you own it. That's all I have this week. Please hit the like button and subscribe. If you enjoyed this content, thanks and see you again next week.